Hello, everyone. Welcome back to Sprague's Market Brief. I'm Taylor Hudson, joined by Hugh McNaughton. It's been a while since we did one of these, but we're glad to be back in the saddle. So today what we're going to do is we are going to reenact a conversation that we are having here on the Sprague contract desk with our customers at an increasing rate of frequency, I would say. More and more people have questions about forward differentials. There's a lot of talk out there by various parties as to what these differentials should be. And we thought maybe if we reenacted this conversation, it might be the best way to sort of answer the question. So Hugh is going to play the high sulfur heating oil retailer, and I'm going to do my best to represent the high sulfur heating oil wholesaler. So whatever you need to do to get yourself in the frame of mind, here we go. We're going to reenact this conversation. You want to make the phone ring, Hugh?
Ring, 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 ring. So, Taylor, why are my prices, or the prices for my heating oil in January, based on ULSD prices? I don't want ULSD. I want high sulfur heating oil.
Well, you've got it right, Hugh. We do quote high sulfur prices using an ultra low sulfur diesel benchmark number. The new NYMEX HO contract is really the new NYMEX ULSD contract. But using one contract to quote a different product is really not new if you think about it. Remember last year when you called in and you needed the kerosene forward wet barrel price? We used the heating oil contract and applied a differential to it to give you a kerosene price. So the fact of the matter remains, when it comes to distillate pricing, there's really only one sort of benchmark price that we use and we build off of. And for your high sulfur heating oil next year, yep, we're using the new NYMEX contract, the ULSD contract.
Okay, in which case, how come a January wet gallon, January heating oil, is 10 cents over the NYMEX, over the NYMEX ULSD contract, but today you'll sell me the same product for 13 cents less than the NYMEX ULSD contract? Shouldn't the differential be lower? And if so, when are you going to make the differential negative 13 cents?
All right, well, hold on for a second, because you're talking about two different things here. You're talking about, in one case, buying it now, that's your 13 cents less than the July NYMEX, or buying it for delivery 6 months from now. That's your 10 cents over the January NYMEX. They're two different things, and we have to look at them separately.
Well, in which case, excuse me, I knew it. That sounds like double talk. Explain what you mean.
All right. Well, it's not double talk, but let's start with what we see today. Okay. So you asked about the why is it 1300 today? So today, high sulfur heating oil is offered to wholesalers like Sprague, okay, at a discount to the July NYMEX. We buy that product, we put it through our terminals, we add a margin to it, and that's why you see a pricing that's actually negative to the NYMEX. I know that's different than in years past, but that's really why you see it. It's what we buy it for, and we mark it up and sell it to you, and we happen to be able to buy it at a discount today.
Okay, in which case, plenty of supply, weak prices, plenty of supply, weak demand, weak prices, and why wouldn't that prevail going forward?
But let's just take a second here. Yes, I agree. It looks like we're at a tremendous discount right now. But remember, we all want to jump to the conclusion when there's a discount that there's a million people with high sulfur product banging down our doors right now trying to get rid of this stuff, and they'll sell it for whatever it takes for us to get rid of it. And we're sucking it down as fast as we can, but we know that we got the sellers on the ropes. That's one type of discounted market environment, but that's not what we're seeing today. You can have a discounted market environment when you have weak demand, and that's what we have today. We don't think there are a lot of buyers for high sulfur heating oil this time of year hanging around trying to buy this stuff. And yes, there's some supply, but we're actually have indications that were there a lot of people to show up and actually want to buy this stuff, there wouldn't be a large discount for the high sulfur heating oil today. So it's an environment today, Hugh, that's characterized really by weak demand against a fairly thin supply offer. And that allows, yes, for a published, discount price to the NYMEX. But I don't want you to get the impression that there's just oodles and oodles of this stuff hanging. If you look at the latest EIA numbers, we haven't seen high sulfur heating oil inventories this low in New York Harbor ever. So there's not oodles and oodles of this stuff waiting to go somewhere. It's more an environment where there's not a heck of a lot of demand, a little bit of supply out there.
Okay, in which case, what do you see when you do try and buy forward high sulfur heating oil?
Right. So what do we see when we try to go buy your January wet barrel? Because you want one, we go try to buy it. Well, guess what? When we go looking for forward gallons, okay, even 1 or 2 months out, Hugh, no one is offering them. No one. There's no physical forward trade for high sulfur heating oil. There's no paper market either. And this is really where the NYMEX change that you and I went through back in April really hits home, okay? Because we used to be able to go and just buy a futures contract. And that futures contract, since it was physically deliverable, guaranteed us physical supply of high sulfur heating oil in New York Harbor in January. And that's the beauty of the futures market, is that you can always find a seller if you want to be a buyer. But there is no paper forward market anymore, and we're not even seeing an over-the-counter swaps market really develop. So essentially, Hugh, there's nobody standing out there saying, hey, come and get the high sulfur barrel. We've got it, and it's at a discount. But we can buy ultra-low sulfur distillate via the futures contract. And that's why, that is why we are basing our pricing off of that contract. If there's no high sulfur heating oil around, then we're going to take ULSD instead. And that's where we've had a lot of discussion about we might see 15 ppm heat in New England way before any mandate for such. So our high sulfur pricing is essentially based on the ultra low sulfur diesel economics, because that's all I can find right now.
Okay, well, this might not be such a big deal if I was just going to be delivering a regular retail heating oil in the future, but I'm hedging forward programs now, and I keep hearing from other suppliers or others that these lower differentials are coming. That's what's making me second guess and hesitate. Is a forward market going to develop? Next week, will my competitor be able to buy a forward differential at that negative 13 cents and get a significant advantage over me?
I don't think so. And the reason I say I don't think so is because I don't think that the suppliers we need to buy from for the high sulfur product are going to do an about face all of a sudden overnight. I mean, let's think about what's sort of the new norm for us. And we see it every day in the wholesale environment. Well, the new norm is, generally speaking, there's less high sulfur around. There's less production of high sulfur coming out of the refineries. U.S. production of high sulfur is relatively low, and certainly East Coast production of high sulfur distillate is low. There's a limited capacity to move high sulfur barrels on the Colonial Pipeline into the East Coast. There's no large-scale tankage available for high sulfur heat anymore. And finally, if you are a holder of high sulfur heating oil, you can't deliver it against the NYMEX anymore. That takes out a trading class of supply that used to hold some inventory just to deliver it to the NYMEX. So, remember what I said before about the current market is thin and the forward market is thin, and I don't see anything, any new supply or anyone getting more comfortable about the position that we're in overnight. So if you come and buy a bunch of wet barrels and put out a program, well, I don't know what differentials are going to do, solidly next week. I kind of doubt that you'll wake up next week and we'll have reversed course, and gone down to a negative 13.
Okay, okay. The fact is, though, that if the differentials still hang on into the heating season, I'm talking about these heavily discounted levels, I'm still worried that I'm going to be overpaying.
Okay. Well, that problem that you just talked about is not new. All right. In the past, you have always compared. You've always beating me up in the spring, Hugh, of the forward differential relative to what diffs might be at the rack during the time of delivery. Now, yes, I'll give it to you that in the past we weren't seeing as large a discount to the NYMEX as we currently see at the racks. But, Hugh, the hedging mechanisms are still the same. Look, if you need basis certainty for your program, the only place to get it is through physical supply. I don't care if it's our tank, your tank, but someone with physical supply has to guarantee you a number on the other end. So you've got the same choices that you've always had when it comes to hedging your programs. If you think forward differentials are too high, Hugh, you can hedge your program outside of a supplier. Okay, you don't have to come to me. I know you can get it done. If you don't think so, and or you want supply certainty at a known price level, then I would encourage you to take a look at the programs we've got to offer. Our fixed forward heat curves are still available. Small volume heat curves are still available. Price flex, physical cap, they all are still here.
Okay, well, I'm still hopeful that the rack differentials are going to be weak. There's lots of supply, or certainly enough. There's less demand every year. New York State has switched to ULS now. That's a whole big chunk of Northeast heating oil demand. The refiners could be dumping this stuff on us. What do you think?
Well, no one knows what future basis is going to be. We don't know that either. But what we see is a lot of rhetoric around there. Going to be a lot of it, not going to be a lot of it, and we think there hasn't been a good amount of analysis done. So for the spirit of that, I want to show you some numbers here. Okay, so everyone can see on their screen here. I've got it, and you can see, Hugh. Here's a table of projected high sulfur heating oil supply and demand for next year. Okay, it runs from this June to next May of 2014. This data was created using DOE numbers from the government, and it takes into account New York State as ultra-low sulfur heating oil instead of high sulfur heating oil, and it uses a heating degree day projection for next winter that is right in the middle of the road. It's an average. So let's just kind of go over it with you so you can see what I'm talking about. What I've done here in the left columns is I've laid out whether it's New England, that's pad 1A, or New York Harbor, that's pad 1B. I've laid out the likely demand schedule for how many thousand barrels per day we might need or might be consumed. So in January of 2014, I think a reasonable expectation for how much high sulfur will be used is 373,000 barrels a day in these regions. Now to the right, I've tried to lay out when we look at what East Coast refiners are producing high sulfur and their nameplate capacities and what the Colonial Pipeline is going to bring up, you have sort of a guesstimate of supply. Yes, it doesn't have imports, but let's just look for a second at what it's going to be without imports. Well, when I look at the summertime here, June, July, August, so even September, frankly, I see balance between supply and demand. We might get a situation where there's a little bit more than necessary and some discounts. Maybe we'll get caught, have a refinery upset or something, and we won't have enough. But overall, it's balanced. Once you get into the heating season, when people that we know in New England are going to turn their thermostats on and turn their systems on, we see, a deficit as much as in January, February of a couple 100,000 barrels a day. That demand needs to be met by something. And we already said before that it might be met by ultra-low sulfur diesel. because we think that there'll be plenty of that. I didn't put ultra-low sulfur diesel supply on this chart, but if I did, it would be adequate to cover it. So if you think to yourself, what's likely to happen to high sulfur differentials in the winter when there's actually demand? I don't know about you, but I don't see this painting a picture of an overburdensome supply of high sulfur available to meet demand and therefore depressed pricing. So if that's the case, then maybe the differentials that are being offered today based on ULSD economics may not be far off when we actually get to the time of delivery, Hugh. I don't know. That call's up to you, but from where we sit today and knowing that the current market is a relatively thinly offered market and looking at these numbers going forward, it doesn't necessarily paint in my mind a picture of a very weak market when we actually get to the time of delivery.
Okay, Taylor, as a retailer, I still have my concerns, but I think you've explained to me a little bit more of the reasoning, the rationale as to why there isn't a discount. You've sort of made a little bit of a convert out of me, and I'm not just saying that because I have to sit next to you all day long. but it now does make much more sense.
All right. Well, thanks, everybody. We hope it lends a little bit of knowledge to this topic, and we're going to put out a written commentary that will follow up with this. Thanks, as always, everyone.